Like we have a pretty full attendance. I'm sure there'll be a few that come on a little bit later as they're coming off of calls. If it's anything like my existence, you skip from one Zoom call to another these days. So hopefully we'll continue to get some as we go. But I'd like to welcome you to our webcast today on creating liquidity through deployment of surety credit solutions in the energy and power sector. I'm your host today. I'm Brad Vescarelli. I'm the National Energy Leader for Marsh Canada. A little bit of background about myself. I'm now been at Marsh for a grand total of 9 years in 2 different time frames. I was originally at Marsh for 8 years and served as a client exec, as a broker in the claims department initially. And then I went into industry for almost 8 years, where I was the director of legal, HR, and the de facto risk manager for a large oil field service company. And more recently, in the last year and a bit, I've been back at Marsh as the National Energy Leader. Before we get started with the content, just a few housekeeping matters to talk about. Today's webinar will be approximately 60 minutes. We anticipate that the webinar portion will be 45, with the Q&A being 15 or so. All participants have been muted, so if you want to ask any questions, please use the Q&A button at the bottom. We do have some questions that came in as a result of the registration process, but feel free to ask questions and we'll do our best to get to them. We have a couple of sections that we've allotted for Q&A within the actual presentation. And if we do run out of time, we're not able to get to the questions that you either asked through the registration process or during today's call, we will happily get back to you with those answers after the presentation. Finally, this session is being recorded, and there will be a copy of the recording as well as the slide presentations that will be available after. So at this time, I'd like to welcome Murray Epp, who's our subject matter expert today. Murray's our commercial surety leader in the Western Canada zone. And Murray has been in the industry for 20 years, 15 of those with Marsh, and his first 5 as a surety underwriter. So now I guess we'll start with the main portion of our content. So if you can flip the slide over, Lisa, that'd be great. So not that probably many of us need a reminder of where we are within the industry, but I thought we'd use this first couple of slides to give some context as to where the energy and power landscape, and predominantly the energy landscape, has been over the last couple of years. As I think that'll give us some helpful background, and it may be good for us to put in context the value of the surety solution. So, the situation we find ourselves in today actually started prior to COVID, and really started with an oversupply of oil. And then with the, as part of that, it was the global economic slowdown and trade policy uncertainty contributed to a year-over-year increase in oil and gas insolvencies of 40% in 2019. Then, of course, sort of early this year, you add in the impact of COVID-19, which has dramatically decreased demand for energy. And what we have today is a supply-demand gulf, which is large, and we think it will remain large even once demand returns, as it will take some time to clear inventory. Elisa? Yeah, so just some stats as well, which kind of puts things in perspective. As of mid-2020, 20% of all energy corporate bonds were trading below 70 cents on the dollar. The forecast loan default rate for 2020 among energy companies was 18%, according to Fitch Ratings. And as we all know, for many of the companies that were fortunate enough to have hedges in place, those are starting to unwind. And as such, it's increasing operators' exposure to low oil prices. So some of the challenges that we're seeing our clients face are debt servicing concerns, dividend cuts, suspensions, or in some cases, total elimination, lack of access to affordable capital, steep stock decline, and ratings decreases. And the responses that we've seen from our clients have included cuts to capital spending, cuts to or shutting in of production, the stacking of equipment, and employee layoffs and or pay cuts. And, as a result, most companies are now being asked to operate within cash flow. Now, I know this is much more an energy focused background than a power, because we also appreciate that the power industry isn't in quite as rough a state as the energy industry. But rest assured, those in the power industry that have dialed in, we do have some examples for you coming up and some ways that we think we can add value to your enterprises as well. So now I'm going to turn things over to Murray. And, just a bit about Murray. Like I said, he's been in the industry for 20 years, and I hope that you find what he has to say interesting and will add value. Murray, take it away.
Thanks a lot, Brad. Great segue or introduction into the Surety Credit overview and why consideration can be given for this product and how it might help balance sheet relief and other opportunities for the different producers, midstream clients, upstream clients in the energy sector. To start off, what we want to do is talk a little about the difference between the commercial surety solutions that we'll be discussing today versus the contractor surety solutions that people generally have some preconceived notions about. In the contract surety space, the bonds that we use, we term as default instruments, meaning that the onus is on the beneficiary of the instrument to prove that the contractor is in default in order to make a successful claim on the bond. The commercial surety solutions that we'll be discussing today are more akin to letters of credit, and what we're talking about today are letter of credit solutions, letter of credit replacement solutions, where we use surety credit instead of bank instruments. So the surety engagement is unsecured and off balance sheet. The security behind a bond facility or a surety credit facility is an agreement of indemnity, and that is an unregistered contract. It's not registered with the PPSA. So just inherently, the surety creditor stands subordinate to the secured lenders and other debt facilities that might already exist. So there's benefits there because it doesn't disrupt those existing relationships. There's been a lot of evolution in the surety credit industry in recent years. I think we like to say that there's been more change in the last 5 years than in the last 25 years. And this evolution has prompted the use of demand instruments, surety bonds that compare very well to letters of credit, and surety-backed letters of credit, where banks actually front ahead of surety capacity and surety facilities to issue letters of credit to beneficiaries that don't accept bonds. We do need to note that COVID-19 and the low commodity prices experienced in 2020 did have implications on the surety market. There's a lot of uncertainty this spring, and because of that, on a lot of deals, we had to use multiple sureties to ramp up the capacity that we required. We experienced a few pricing corrections for existing clients where the surety market decided it was time to ramp up the costing models. But the good news was that during this time, when surety bonds or surety engagement actually existed for our clients, the surety markets in general held cover, meaning that they didn't actually change their appetite on existing exposures. So we can quickly talk through the benefits of using surety credit and how it can benefit your organization. First of all is balance sheet relief. And the sweet spot for this benefit probably lies in that BB to low investment grade space where there's a concept of or a drive to have some liquidity relief. Surety credit doesn't impact working capital, doesn't impact your debt covenant ratios, and it doesn't draw from your credit facility. So at the end of the day, your balance sheet can be left free of the implications of having this additional capacity being used or deployed. Surety credit provides an increased credit capacity, which creates headroom when you look at your overall capacity available on a credit basis. I know that during COVID, a lot of our clients did risk mitigation draws on their revolvers or on their credit facilities. And the benefit of having used surety capacity already meant that they had access to that capacity on their revolvers to make those draws. Another point is creditor diversification, basically having separate tranches of credit capacity available whether it's through your revolver for a sublimit of letters of credit, whether it's bilaterals with letters of credit. You're adding on another tranche by having surety capacity available. And the way this complements your existing lending agreements is that inherently the bonding company or the surety market is actually subordinate to your secured lenders. So they rank in priority below the secured lenders, and it should not disrupt any existing relationships. We've had some instances where the lenders want to learn more or have some concerns about that, but normally what we can do there to provide comfort and confidence in the priority ranking is establish intercreditor agreements where necessary. The surety markets that we engage for these demand bonds and these surety-backed letters of credit have very strong external credit rating agencies. The Standard & Poor's range is basically from A to AA+, which is in line or arguably even better than the big 5 banks in Canada. And of course, there are cost savings to be made by deploying surety credit. We're still in a soft market, unlike our insurance counterparts, and we feel or see that we can generally save our clients up to 20 to 30% versus just the base rate letter of credit structure. And I say the base rate letter of credit structure because with bonding, there's not the death by 1,000 cuts that you might experience from your bank. There's no service fees, setup fees, transaction fees, or standby fees and commitment fees for dormant capacity. So there's certainly benefits beyond just the rate comparison. On the flip side, however, if you do establish a relationship with a surety company who's going to backstop bank fronted letters of credit, the banks will charge a fronting fee that might offset those savings. We wanted to chart out or show just exactly where the costing models are in the surety industry. And so we took a small sample size of extraction industry clients to build out this graph. So you can see there's definitely a trend. A couple things that's interesting about it is when you get to the left side of the graph, when you start getting into the lower ratings, instead of an inflation in the actual bond rate, what you'll see is the sureties asking for partial collateral behind their bond facility. So unlike the banks where it's pretty binary, either they extend the credit or they fully collateralize behind their letters of credit, the surety industry will in fact do partial collateral behind their facilities. For example, 40% cashback surety bond. So it still creates a liquidity event, and the pricing is still manageable behind the cost of surety credit. So the structure of a demand bond is something we wanted to talk through today. It's very comparable to a letter of credit. In fact, it's built to compete directly with that. And what we plan to do is give these obligees or these beneficiaries of bonds and letters of credit confidence that they can interchange the two instruments without being exposed to one being stronger than the other. The simple demand bond structure is really made up of 5 basic premises. One of them is that the trigger for a claim is just to declare default. We call these demand bonds or event of default bonds. But what that means is that as soon as the beneficiary of the instrument declares default, then they can claim on it, and there's no defendable position for the surety creditor to take. Unlike a letter of credit, which is site demand, which means in theory you should be able to take a letter of credit, drop it onto a teller's counter, and get paid. I think we all know in a practical sense that's not exactly how that works, and normally there's a few days before that payment might come through. The surety bonds actually prescribe a payment term. It's normally in that range of 5 to 10 days, 7 to 10 days being the most common. But what that does is just allows the surety companies to access their liquidity facilities in order to make payment when that declaration of default is made. The surety instruments are evergreen in nature, just like a letter of credit. The difference there is that a letter of credit will have the option for a notice of non-renewal, normally 90 days. The surety bonds have what we call forfeiture language, meaning there's 90-day cancellation notice. But if a replacement security instrument isn't provided within 60 days, then the beneficiary of the instrument can claim. What we do to provide clarity in the event of a claim is we actually attach as a schedule to the demand bond a notice of default. And what this can include, it could even get as granular as including wire transfer information for the surety to make payment to the beneficiary of the instrument, And it just provides clarity for all parties that that's how the claim process works. And once the notice of default is filled out and made and sent to the benefit or to the surety company, then the prescribed payment term, the clock starts ticking for that. And arguably the most important facet of these demand bonds is the waiver of defense. Language that provides really important clarity that the surety has no other remedy than to actually pay out under the bond when a notice of claim is made or a notice of default is made. So when we build these bonds, we try to make them simple and very succinct. I know that a lot of lawyers like to get their hands on them and create, 5-page, very verbose bond wordings, but because they're tied to the underlying contract or legislation, we feel it's more important that the terms of default are defined in that underlying agreement, and that the bond itself is just made to have those 5 items noted above that really define and protect the beneficiary, from any defendable position on the surety. And then the underlying agreement can really list out what triggers a default, what's event of default, and when the beneficiary can draw on the instrument. Next slide, please. So the surety-backed letter of credit structure, this is something that's in its relative infancy in North America. Marsh has done a number of deals, both sides of the borders, but it's really something that's relatively new. But surety companies are starting to set up this structure with their banks, and we're seeing more and more of it, and it's certainly opening up a window of opportunity. It's not different than what we see globally, where banks front for other banks in different jurisdictions. You'll see that a lot where you have a foreign operation, you need to post a letter of credit to someone domiciled within a different jurisdiction, and the bank will front for another bank by issuing that letter of credit. And often these surety companies that engage these banks, whether it's managed through Marsh or deal specific or whatever, turns into an actual facility where the banks have actually approved specific limits for each surety company, and then that can be deployed at the surety's discretion. And so it's not even tied to the applicant itself. You'll see on the flow chart that there's an indemnity agreement still, just like a regular surety relationship between the applicant and the surety, and the bank is not party to that agreement at all. And then further to that, when the surety provides a counter guarantee to the bank, the applicant's not party to that actual guarantee. When the letter of credit is issued, the applicant is named on the document just to meet the beneficiary requirements, but there's no actual relationship necessarily between the applicant and the bank in relation to this deal structure. So the banks fronting ahead of other banks have really sort of set the guidelines on how these counter guarantees work. The counter guarantee from a surety to a bank is normally or generally subject to the same rules that the International Chamber of Commerce has laid out for bank-to-bank counter guarantees. There might be some nuances or accommodations on the indemnity agreement between the applicant and its surety company when we do this LC fronting. One of the things that we've seen is an amendment on the indemnity agreement that will allow for a 5-day payment window or something like that, where the applicant has to pay back the surety who has to pay back the bank. So they really tighten the timing in relation to those paybacks just to make sure that the bank's made whole in the event there's a draw on a letter of credit. One of the challenges we faced is the negotiating the fronting cost structure. So some of the banks are a little bit off market. They're interested in this product or this deal structure, but their fronting fees are such that they price themselves out of making it practical. We normally strive for somewhere in that 25 to 35 basis point range. Some of the banks will have different fronting fee structures for performance obligations versus financial obligations. And what's interesting there is every bank seems to define performance versus financial differently. So it's important when you look at different types of structures or different obligations to make sure the right bank is being approached by the surety company. Next slide.
Okay, so we've actually built in a bit of time to answer some questions, and there are some that have popped up while you were talking, Murray. I guess we'll style these the questions related to surety credit and deal structure. So one of the first questions we got was, do you need a rating from a credit agency in order to pursue a surety bond?
You don't. And I know that the costing graph, or the scatter graph that we showed earlier, did stack ratings up against bond cost. That's just an easy way to sort of tie the credit strength of the applicant to the rate structure. But we do a lot of deals for unrated clients, and there's a lot of opportunity out there. Normally what the surety companies do is they perform their credit analysis, and then there's an implied or internal credit rating ascribed to every applicant anyway.
Okay. So another question we got here was, why would a company use the letter of credit fronting solution considering it costs more?
That's a good question. And really the answer is that it's beneficiary driven. So there's always going to be instances where your counterparty or beneficiary that requires the security will say that they don't want to pursue the option or explore the option of a surety bond. So they'll only accept the letter of credit. So we deploy that strategy where the surety capacity backs a letter of credit fronted by a bank. Or it can be an instance where they're considering a surety bond, but we're in the process of negotiations that might be protracted. So we use the letter of credit front in the meantime until the bond's accepted.
Okay. And then one final before we go on to the next part of our presentation. So some companies have both LOCs and surety bonds. Is there a benefit to having a portfolio that includes both? And if so, what is it?
Yeah, absolutely. So we touched on that a bit earlier about the balanced portfolio and the advantages there. And the best part of having separate tranches of credit capacity available, you might have some headroom on each of those, so that in a rainy day, you have capacity at your fingertips. And so it's a bit of a risk management tool. And if appetite changes from one of your creditors, whether it be a lender or a surety creditor, then at least you have optionality, and you can leverage the other tranches of credit to find solutions. But the other thing is that it also creates competition between the different lenders. And we've had circumstances where we've crafted surety solutions, and when the treasury group of our clients went to their bank or their lenders and said, we're going to be replacing these letters of credit, it was actually advantageous to our clients, and those lenders ended up dropping their letter of credit rate to the benefit of the clients as well.
Okay, Murray, so I said that was our last question, but as you've been answering, it's been prompting other questions. So I have a couple more still here, so hang tight. So one of the questions I got was, how are surety bonds priced? And I assume that was after you answered that you don't need a credit rating in order to pursue a bond. There seems to be obviously a relation between rating and bond pricing, but what other factors are used in pricing a bond?
Well, normally the surety bonds are priced in a similar fashion to a letter of credit. So, it's so many basis points per year or per annum, and that structure along compared to. One thing that's interesting about surety credit is normally the first year that the instrument's issued, that first annual term, the bonding companies often consider that premium minimum and retained, meaning that, even if there's a change or the bond's released or decreased, there's no return premium, but we've been able to negotiate out of that structure for the benefit of some clients.
Okay, and I guess one more big question, picture question, which is interesting. The question is, while liquidity challenges for E&P companies put strain on the banking relationship as perceived credit risk, aren't the surety underwriters also leery of these E&P companies? And therefore, is there a concern they won't write the risk?
Absolutely. Yeah, there's been capacity attrition and appetite changes in the market. And there are some sureties that stay arm's length from the energy industry. The oil and gas industry certainly has had its challenges, and there's balance sheet implications related to that changes sort of the credit landscape of certain applicants. So there are some struggles there. There's definitely some challenges. There's a bit of, and I told you so perspective on this as well, where our clients that have surety credit arrangements already, when they engage the surety markets during the good times, they had the benefit of those sureties holding cover and capacity while the industry faced these challenges. So definitely something to consider in sort of a cyclical or commodity-based type industry is to engage the sureties, engage the creditors when times are good, and chances are that'll hold through the difficult times as well once a relationship's established.
So just to that point, Murray, is it fair to say that although there are some challenges, that the surety market isn't as hard, if you will, as the P&C market or property and casualty market in the insurance industry?
Absolutely. Yeah, there's a lot of capacity out there in the surety industry. And for the right deal, the right underlying agreement that sort of defines what constitutes default, we are finding solutions out there in your industry. The oil and gas industry isn't necessarily a pariah to all of the surety underwriters, and there is some market appetite, and we've had some good success even during COVID and through the spring and summer of 2020 to place deals.
Murray, the questions just keep coming, so hang in there before we get. This is good. You're obviously hitting on some points here. Next question. Sounds like in some instances the surety is taking security, i.e. subordinate to lenders. When would the surety take security?
When the surety companies take security, they're not really attaching themselves to your enterprise's assets. The security that they're taking is, we call it collateral, where they have the agreement of indemnity, but in order to facilitate the deal just from their own credit metrics and perspective, they want to take collateral in the form of either cash or a letter of credit for a portion of the deal. And what that does, it means that if you're looking to free up 10 million, the surety company is not quite sure about the balance sheet or the outlook for the company in question. They ask for a $3 million letter of credit and issue 10 million worth of bonds. So there's still a net $7 million liquidity event. And that's really the type of security that they take, is that sort of collateral structure. They don't attach themselves to the specific assets like I mentioned earlier, and they don't register their indemnity agreement with the PPSA until the event of a claim or a draw on the instrument.
Okay, and next, wow. Don't the underwriters have the ability to call on your surety for any reason, which means you have to keep that, quote, liquidity that was supposed to be freed up aside in case there is a call?
Yes, generally they do. So that's an important facet of the underwriting discussion is what's the liquidity of the company in question? And if there is an event or a claim or a draw, can the surety be made whole or be paid back for the exposure? And I think what you're also touching on is what we call place in funds language, which is on the contract of indemnity for a lot of these surety deal placements, which essentially is the surety company has the ability to call for collateral behind their exposure at their whim. And normally what that means is that if there's a significant downgrade on the credit quality of the applicant, then the surety company can call for collateral. In a practical sense, even though it's inked and it's part of the contract of indemnity, what we find is that's leverage to bring everyone to the table and actually negotiate next steps. Because the surety, they understand that they need to mitigate their loss, and they want to work with their applicants and their clients that they have relationships with to manage through those difficult times.
Good. So Maria, I think there's a couple other questions here along the same line, and I guess I just want to make sure that everyone is on the same page. There's some concerns about the fact, and I think we saw this with trade credit, for example, when companies needed it most, the trade credit companies stepped out and wouldn't provide it, right? So
yeah.
Is there a sense that there's enough capacity to fill the needs from a surety perspective, despite some of the challenges the industry is having?
Yeah, I mean, in a broader overarching sense, we are doing deals. We are getting deals done. If we point to the external credit rating agencies, I mean, I've had downgrades into the triple C's where my bonding partners have held cover for, hundreds of millions of dollars worth of capacity because they like the story. They like the story behind the enterprise, not just the balance sheet. So we are getting deals done. And I think that like we mentioned, it's a soft market in relation to price, but it's also a soft market still in relation to capacity. I will say that if you do engage the surety companies when times are good, that their ability to hold cover and having that optionality when times are bad is definitely a lot easier. The inception of a facility during these times might be more difficult, but we are having success. So it just depends on, you know, the overarching credit strength of the company, but also the underlying agreement and each bespoke deal that we do. Obviously, we do it when we build out a bond wording or build out an underlying agreement to make it make sense. We align ourselves with the surety's appetite as well to make sure the deal can get done.
Okay, so I know I want to be conscious of time and the fact that you have some slides coming up that talk about some solutions that you've been able to generate on behalf of clients. But with that said, one more question, then we'll move on. The question was, has the underwriting criteria changed at all as a result of COVID? And is there any info the underwriters need to see around managing COVID-related risks?
You know, that's a great question. And so what we've ended up doing is spending a lot of time bringing our clients, having one-on-one calls with the surety companies just to talk through COVID, how they're managing safety, how they're managing, you know, liquidity. And it's been well received. The surety markets like that attention. They like the fact that when they do their write-ups or review their position on different obligations, that we have those discussions and create that transparency. I will say that there have been implications. I know there's a couple deals, you know, in the $50 to $100 million range that we did this spring and summer, where normally, if going back 18, 24 months, one surety would have jumped on it, closed out the deal quickly. This took, you know, multiple sureties to ramp up to that capacity. So I'm not going to say that COVID hasn't impacted industry. And there's certain markets where their appetites changed entirely. And during the spring, especially, there were some markets that were closed for business. But I think that uncertainty is behind us now, and we're seeing a lot more appetite and reasonableness in respect to their approach.
Okay, so I think we should move on, but there will be another Q&A opportunity later on in the presentation. So keep the questions coming. I think it's most valuable when we can have these interactive discussions and make sure we're hitting on the questions that the attendees are interested in and are most pertinent to them. So there will be another opportunity, so keep them coming. Next slide.
All right, so yeah, we wanted to break out, I guess, the session into two things. One, to discuss surety credit, deal structure, the types of bonds and solutions that we use. And now we're going to get into more the applications for surety credit and how it can be deployed to the benefit of different companies. This is really just a sample list of solutions. Really, anytime there's an application for a letter of credit, there's an application potentially for a surety bond or a surety-backed letter of credit as well. One of the most obvious uses of surety credit that stands out is in the decommissioning and reclamation financial assurance space. Not necessarily locally for this industry, but certainly for other industries and a lot of other jurisdictions. The reclamation financial security is something that we issue a lot of bonds for. There's a tax appeal court security solutions where, you know, we've seen hundreds of millions in letters of credit in different court disputes where it's posted to the court, and there is opportunity there to use surety bonds in lieu of letters of credit. We've had some discussions with some tax lawyers, and there's some legal opinions on the street that really suggest that even though it needs to be done on a customized or bespoke basis every time, there is opportunity to use bonds for that type of security. Then there's the pension security, and there's two sides to this. One would be where pension's underfunded. There's some solvency ratio triggers that require security, and we can issue bonds for that. The other is to use bonds as an actual funding mechanism on executive pensions. So on those SERPs or RCAs where the letter of credit is actually the funding mechanism as part of the pension. The trustees have been known to accept bonds for this as well. Lease payment security, advance payment security, insurer collateral is one where we've had some recent success. I know that especially any enterprise with operations stateside, workers' comp, casualty, There's requirements for self-insured retention collateral, and the surety industry has really stepped up in recent years to accommodate those. In the power side of industry, there's opportunity for PPA security. And we can talk about that in a little more detail later. And then, of course, the independent system operators and regional transmission organizations accepting security as well in the form of bonds. In Canada, I guess their peers would be known as the IESO in Ontario, and then AESO, the AESO, or the Alberta entity as well. Neither of those currently accept bonds, but there's definitely opportunity for the surety-backed letter of credit. And in the energy industry, the TSA, the Transportation Services Agreements, there's been, I think in the last 18 or 24 months, massive change in appetite in that space, where sureties are issuing bonds to the midstream companies on behalf of producers. And another thing that might come up is foreign jurisdiction security. An example there is when Pemex was selling out blocks of their production assets in Mexico. They were, taking 50% deposits, with the other 50% being met by letters of credit. Certainly an opportunity there for the surety-backed letter of credit when you run into opportunities like that. So this summer, we had an opportunity to help out a few clients by establishing lease agreement security. And in both instances, there was an opportunity to pay a lump sum, but just given the current economic times, our clients chose to break that out into installment payments and develop their structured lease agreement as the underlying contract for the security or for the bond. In both instances, what was interesting is that the security diminishes over time as these payments are made throughout the life of the lease agreement. It was a great liquidity solution and definitely well received. One thing I guess that this sort of triggers a discussion on, though, is the regulatory environment for surety. And what these circumstances did is created a scenario where the sureties had to check or challenge the regulatory environment just to make sure that they could provide support on these lease payments. And so obviously OSFI, the Canadian regulator, was looked at. And in 1991, for those that don't know, OSFI actually issued a memo in sort of a knee-jerk fashion because there were some surety companies guaranteeing the payment of principal and interest on loans. And so they laid a memo on the table that still stands today and is still out in industry, that we cannot guarantee that those types of obligations, but it's very specific about the payment of principal and interest on loans. And this type of lease agreement security circumvents that, and is something that's deemed possible or allowed within the regulatory framework. The other strong regulatory concern is Appleton, and the Appleton rules are defined in New York law. And the difficulty there is there's specific description of financial guarantees and what can or can't be done by use of surety credit and insurance credit. But a breach in any other province or state would actually breach Appleton law, even though New York state might not have any oversight over another jurisdiction. They'll still inhibit the ability for the surety company that breaches it in another province or state to do business in their own state. What's interesting about Appleton especially is its nuance. So every surety company, has a different description or definition of where the line in the sand is in relation to regulatory pressure and appetite. So we definitely test the market if something comes close to what's deemed to be a financial guarantee that might upset Appleton law. And we know that a handful of sureties probably will write it, where a handful of sureties won't. So we touched a little bit on the ISO and the RTO securities. ERCOT and New York ISO actually did have bonds on the street. Very few sureties supported them. They're very onerous in nature. And this summer we were excited. PJM Interconnection out of Pennsylvania, who is one of the RTOs on the eastern side of the United States. We knew they were going to make an announcement this fall in September that they were going to start accepting surety instruments in addition to letters of credit. But when that instrument hit the street, when that template hit the street, It was incredibly onerous in nature, with a 1-day payment window and a few other particulars that just made it so that no surety was willing to write it or has been willing to write it so far. What's interesting though is we have been able to create surety-backed letter of credit solutions for our clients for PJM as well as ERCOT and New York ISO. So there still is a solution there. It costs a little more, but I think there's some benefits that are realized by different clients. I just want to caution you though that in this instance where the surety companies preferred to actually have a letter of credit issued over a bond, that's very unusual. And we don't see bond templates that are that onerous. Normally the preferred means and the less expensive means obviously is a surety instrument. So as mentioned earlier, the TSA Security is something that's really evolved in recent, I guess, 18 to 24 months. We've seen a lot more midstream companies accepting security in the form of a bond. Some of these midstream companies will only accept a surety bond for up to 50% of the overall security requirement. So what we've done is on a specific instances, create a blended solution where there is a 50% surety bond and then also a 50% surety-backed letter of credit. The producer client, I guess, really liked the solution so much, and the fact that this obligation was taken off their balance sheet by the use of surety credit, that they were okay to take on the additional cost of the surety-backed letter of credit for the second half. And then the bond and letter of credit were posted to the midstream company. So insurer collateral, that self-insured retention component we spoke about earlier, workers' comp, casualty, auto, and then of course, captive fronting collateral. Marsh is actually working on sort of a program basis to manage this for our Canadian clients, where we want to bundle, all of our clients together that have collateral posted to the different insurance companies, and then go to market on a letter of credit fronted basis and try to really drive it down on a program basis so that we can, manage overall cost, manage appetite by bundling, the best credit cases with the weakest or the less attractive. So that's something that's underway right now. And there's certainly opportunity, especially in a hard insurance market where we're seeing, some of the markets that were accepting bonds for a portion of their collateral are actually pushing back now and not accepting it for any. We're having success this month issuing a bond for a new OIL member who needed to post collateral in order to become a member of the mutual. So that's something that should be out the door here in the next couple of weeks. And we're just excited that OIL is starting to accept bonds for that type of collateral as well.
So Murray, just maybe a quick interjection. I think this type of solution, I suspect, will become more and more popular given the hard nature of the insurance market on the P&C side, and requests from underwriters to take on larger SIRs, and with companies with captives finding that they're going to be utilizing them more to help smooth out some of the effect of the hard insurance market that we're in right now. So I just wanted to highlight that I think we could see more activity in this area as we go forward.
No, that's a great point. I think we're pretty excited about it because most banks treat it as a financial obligation, but we found a bank that actually treats it as a performance obligation, which means we're in a position to manage the bank fronting fee. And so now what we want to establish is a list of all of our clients that will need this, and go to market sort of en masse so that we can have some leverage and really structure a deal that works to the benefit of everyone during this hard market times. So the last example we wanted to touch on was just the power purchase agreement security. So in the past, I worked with a provincial crown corporation utility to help develop a financial guarantee bond. And it's used sort of on both sides of the equation. So where the independent power producers are bringing in electricity to the grid, they post surety. They can post the surety bond as collateral in relation to that contract. volume and delivery guarantees in relation to bringing in that electricity from their plant. And then the other way too, where the Crown Corporation, has to build out infrastructure to accommodate a new facility or deliver power to a new facility that's being built. Obviously, they want some guarantees that build is going to be justified, and so the owner of the new facility can provide a financial guarantee bond to that Crown Corporation, just to guarantee certain volumes of purchasing power.
Okay, so before we get to the last Q&A questions, we do have a prompt for you to advise, help, I guess, better inform us as to what sort of webinars or presentations that you'd like to see from us. Part of our mandate going forward and my role is that we don't just want to sell you insurance. We want to be a risk partner. So as part of informing that, we'd like to hear from you as to what other areas you'd like to get more information from. So we have a quick polling question, and then we'll head to the last Q&A. We'll just give it a couple seconds here, and Elisa can let us know when we've got most of the people in.
One more minute, Brad.
Okay.
Good to go?
All right, so let's get on to our last Q&A session. There has been a couple of questions that have come up on this last section, Marie. And I think a couple of these you might have touched on, but I want to make sure that the specific question is asked in case you want to expand. Which ISOs or RTOs have you seen accept surety credit?
So ERCOT has a prescribed bond on the street. It's, like I mentioned, a very onerous bond. So does New York ISO, but both of them have accepted bonds for those obligations. But not every surety will support it. And that the low watermark, I guess, is financial strength of the applicant is probably a little bit higher, just given the nature of those bonds. I mean, we've exhausted discussions with the Canadian ISOs to some extent where they didn't want to accept bonds. They want the letter of credit, and they didn't, I guess, look to provide optionality to the street. But what we did there, or what we can do there, is do that surety-backed letter of credit solution instead.
Okay. And again, one that you touched on a bit was, what is the acceptability of surety bonds by the midstream industry and the costs and pitfalls?
So the surety industry, or sorry, the midstream industry has started to accept bonds. And I think every midstream company has at least, entertained discussions on acceptance of bonds, even if they're not at the finish line yet. So there's been a really good evolution and acceptance of the bond product in that space. That provides good optionality for the producers. I think that, even if it's a balance of letter of credit and bonds, there's been a lot of good success in the industry. And the pitfalls, well, I think that the midstream companies have done a good enough job of building out the bond templates to meet their appetite for risk. And so they consider or deem it to be interchangeable to a letter of credit. So no real pitfalls, really just the benefit side of using surety credit to balance out your portfolio.
Are there bond templates for demand bonds available, i.e. standard bond forms?
I wouldn't say there's standard bond forms, but we do have one that we share or use as a base point for negotiation when we're helping clients work on a deal. And it's really stripped down to those basic 5 tenets that I just described earlier about the demand bond structure. That's something I can definitely share or talk through with anyone who has interest.
Okay, and one more here so far, and I would have been disappointed if someone didn't ask this because I know we talked about this, Marie. Have you had any discussions with the AER about them accepting surety bonds?
Yeah, so my understanding with the AER right now is a bond template was developed. There was a big push from industry. There was, a pretty good reception from the provincial government and the AER to bring in industry to talk through, the basic function of a bond, how it would look, how it would work. The bond, so that I guess there's two things happen. One is that the first announcement for acceptance of bonds came from the AEP, Environment and Parks, who has oversight or governs the sand and gravel industry. So the bond that was being discussed, I think more for the oil and gas industry and for oil sands mining, ended up hitting the street for sand and gravel, and it wasn't a good fit. And the reason for that is there's so many mom and pop shops in that industry that to get a demand bond support from a surety company is difficult. But the bond template is there. It's sitting in government. It's my understanding that it's had legal review, risk review. The Treasury Board's reviewed it. And so now it's really just up to the Alberta Energy Regulator to make that decision to start accepting it. I think it's everyone's understanding that if they do start accepting it, it'll initially be for mining obligations, which is essentially in Alberta oil sands and coal. So the liability management ratio, the portfolio security on that side, I think we're a ways off from having the AER accept it there. But we're looking to challenge the surety industry for that whole premise of surety-backed letters of credit to see if that can be established on that portfolio basis. It is a little more difficult for the surety markets to respond to, managing a liability management ratio portfolio as opposed to specific assets. But we're starting discussions to get that done.
Excellent. So last call for questions. I think everyone got their questions out in the first question and answer, Murray. So you might be off the hook a few minutes early. We might give everyone 5 minutes of their time back. So anyway, Murray, thank you for helping out today in the presentation. I think that, again, to reiterate what I said earlier, I think the main hope here is that we are becoming more aligned with what the industry needs, and we want to help offer solutions to some real problems. And we think that surety is something that not only can we provide a solution to, but we can get some traction on with the surety market. So I would encourage you, if you have any questions outside this forum, that you reach out to Murray or myself. We'd be happy to get back to you. Also, would be happy to meet with individuals one-on-one or their companies or other members of their company to help flesh this out a little more. So everyone, thank you so much for your time today. I hope this was informative, and we look forward to presenting to you again in the future on another topic that may be of interest. So take care and have a great day.